Hello, everybody. In just a moment. Okay. Hello, everybody. Welcome to the live stream. It's Friday, and that means there's lots of opportunity today to talk about what's going on in the market. If you can hear me, please go ahead and drop a message in the chat for me. I just want to make sure that my microphone is working. Um, okay. Thank you, John. Appreciate it very much. Wonderful. All right. Well, I'm excited to see everybody here, and hopefully we'll get a few more coming in as we get things rolling. And perfect, you can hear and see. I really appreciate that very, very much. Everybody, this is, if you've attended some of the webinars we've done in the past on GoToWebinar, this is obviously a little bit of a different format. Instead of giving you the opportunity to be able to turn on your microphone and speak up, this is something where if you have a question or a comment, you will need to use the chat. So please feel free to do that. I am going to be watching that throughout the course of the live stream, and we'll try to fold your comments and your questions in as we go. Everybody else can see what you're doing there as well. So these messages are not coming directly to me only. So just be aware of that. Okay. With that said, let's dive right in. It is Expiration Friday, last Friday of September, so we'll be starting a new month next week, and that'll be fun. But that does mean that there's always options that are set for expiration, and that means there's always an opportunity to review current positions that may be coming up for expiration. Barry, so we can't talk. Well, that's really up to you, isn't it? Barry, he says, so we can't talk about others. I mean, if you want to, I'm going to try not to, but if you want to, it's up to you, I suppose. Thanks, Barry. I appreciate the chuckle. All right. There is one stock that is set for expiration day, so we'll be getting to that. Whole bunch more that'll be coming up in the weeks ahead. The market has been kind of interesting for the last week, following what everybody was hoping for, which was the Fed rate cut last week. It looks like the market has been finding a reason to be quite a bit more bullish lately. So we can see here's the Nasdaq. It is pulling back just a little bit today, but coming up near its all-time high that was reached in July. Here's the Dow Jones, just for a little bit of perspective on the broad markets. Set a new high earlier this week, and it's pushing to a new one again today. And then the S&P 500 is not quite as strong, but is also sitting right at its all-time high as well, which was reached yesterday. So all three indices are generally moving in pretty bearish fashion, even with whatever may be happening today. And so that's giving the market a lot of momentum, and a lot of the stocks that I've been following and that you may be following as well have been seeing some pretty sizable increases over some pretty sizable moves, I should say, over the last few days. That's offered up an opportunity to place some new covered calls in batches, which doesn't happen very often. But if you were following the trading alerts that I posted on the Discord server this week, then you saw what those were. Just one quick note about Discord before we dive into these. I do want to reemphasize the need to make sure that you've joined this server and so that you are getting the latest and greatest information from me at all times. The recordings, the links to these live streams will be posted here under the live webinar channel. Each general, I try to get them as early as I can on Thursday before our Friday session. I was a little bit late yesterday, so I apologize for that, but you will always see those here. Later today, I will go ahead and post a link to this live stream for view under the recording, so you can always come back and review this again later if you want. Those of you who may be looking at this after the fact as well. Now, just to be clear, after the weekend, I will be putting this up on my YouTube channel so that other people can see it as well. This is to try to give them an idea of what all of you as members of the Rebel Income community have access to, and try to get the most updated information on some of the things that we're talking about. We may have some time today as well to open things up to stocks that you may be following that maybe fall outside of the universe of stocks that I've been focusing on, that you see me write about with Rebel Income and that I trade. My trade alerts will always be posted here under in the trade alerts channel, and you will see me outline 3 specific possible trades. First will be the put sale that I always like to place. Covered call is an alternative, and if you want to be even more conservative, there's a bull put spread as well. So you can choose the trade that you feel like makes the most sense to you. One of the additional benefits that you all have as Discord members is access to the reports that I write Monday, Wednesday, and Friday, where I go through a detailed analysis of a specific stock in my watch list, or that's crossed my desk in the Rebel Income universe. I apply the Rebel Income criteria against that stock to determine if that's something that might fit as a good opportunity. And so you'll see a summary of those reports here in this channel. This way, you're seeing content, you're seeing information from me literally every day of the week. Thursday, I also post an article with a little bit more detailed dive into some of the specific elements of the Rebel Income system, and try to give you some more information there. If you're new and you're just trying to figure out what to do and how the Rebel Income system works, a couple of places I would suggest starting. Number one, in the Rebel Income Welcome channel, you'll see kind of an outline of the way that the channel has been set up. Under Getting Started, there are several videos, including everything about the main elements of the Rebel Income system. You also have access to my home study kit, which includes a whole lot more video content about trading in general. And you can also download my ebook here, Trade for All Seasons, if you like as well. Okay. Lastly, as Discord members, I want to make sure that you have access to the content that I post on YouTube before everybody else. So this is the early access channel. You'll see me post links to the videos that I post on YouTube at least a day in advance of making them available to the public. So, okay, let's go ahead and move on. Let's talk about the market and what some of these current positions have been doing. Here's my track record. We really just have a couple of positions up for expiration today. One is Comcast, the other is Nike, and then of course we have a whole bunch coming up in the month ahead. Really, I've kind of loaded up on expirations for the third week in October. It's just kind of the way that things have lined up. We'll take a look at some of those and see where a couple of the put sale positions that we've placed recently line up. So let's start with Comcast. This is a trade that was placed the first week of September. I sold the $39 strike price, and brought in about 1.67%. So it's a nice trade at that particular price. Comcast is a really interesting company. And so let's go ahead and switch over here and take a look at their stock. All right. Let's go ahead and do it without the watch list. All right. So we can see roughly the last year of activity here for Comcast. As I mentioned, I sold the $39 strike price, and we can see the stock is clearly rallying up here close to $42. Which means that this option is all set to expire worthless. And my strike price is down around in this area. So for most people who are using put selling as an income generating strategy, this is kind of considered an idealized result. No expiration means no assignment, means I get to keep the entire premium that I brought in on the trade. And the $3,900 for the one contract that I sold on this will come back and be available to me for a new trade next week. Of course, as always, one of the things that you can always think about doing here, and we visited this a little bit last week, but you can also always think about the possibility of managing your trades in advance of the expiration date. You don't have to wait till the day of expiration if you're getting a healthy move in your favor. Maybe you decide you want to try to manage this a little bit more actively, and that's okay. Here is the $39 strike right now, and you can see not really a lot of activity here, but considering the distance that the stock has moved away from that strike price, above it, it's not really a surprise that the asking price on this is a penny. Now, what does that mean? And please answer this in the chat. What would be the advantage here on the expiration day of buying this option back as opposed to just letting it expire? Which, let's face it, that's what I usually do. Why do one versus the other? Let's get some discussion going. All right. Well, basically, Barry, my wife is talking to me. What was your question? Sorry, no problem. So the question is, why buy this back now before the expiration date, which is just a couple hours away? Why do this on the day of expiration potentially, as opposed to just letting it play out, letting it expire, and then waiting for next week to come and deciding what you want to do? The short answer is that the capital that you would reserve for the trade, yeah, thank you, Barry, releases your capital sooner. You're exactly right. The advantage here is that when you buy an option back from the market that you've sold as being the seller, buying it back before the expiration actually happens releases the capital that you've used to reserve the trade a lot faster. Now, you if you're selling puts, you may do that on a cash secure basis, which is my preference. You may use a combination of cash and margin, or you may do it on margin. Especially in my experience with some of the clients that I know are active rollers, especially if they're using margin, this is kind of a big deal because the opportunity to release that margin requirement sooner is an advantage. Number one, you pay a little bit less in interest, but just as you would with cash, with a cash secured kind of put, the entire amount that you reserved, $3,900 in my case, since I sold one contract, is released back into the account and it's immediately available to use again. That means that you can increase your trading frequency. Now, this is why I said you don't have to wait until expiration day to do this. If you have an opportunity a week in advance, 3 days in advance, 2 weeks in advance, depending on how far the stock has moved, this is something that can be an advantage. But even if it's the day of expiration, this is something that can be an advantage for you. Now, here is what I mean. Let's go back here to my track record really quickly. Here is the position that I have for Comcast, and I want to focus for a second on the duration of the trade. I placed this on the 4th of September. It's a 23-day trade since it expires today. In literal terms, though, by letting my option expire and waiting for the capital to be released in using normal market settlement procedures with my broker, I'm instantly forcing myself to wait an additional possibly 3 to 4 days. That's because the trade won't settle until the weekend has passed. It's Friday. Most brokers, even if they have a 1-day settlement, that's usually market days, which means the soonest that capital will be available is Monday. Broker that I use typically has about a 2-day settlement, so it's usually Tuesday before that becomes available. That's 4 days on top of the 23. So in literal terms, my trading frequency with the same potential capital is really more like 27 days. Here's how that translates. Let's use the same yield number, 1.67%, to put this in perspective. Here's 365 days in a calendar year. And if I divide that by 27 days, that means I can't do fractional trades here. So effectively, I can place 13 trades per year with the same capital. This is all theoretical. These are sample numbers, understand. This is going to vary from trade to trade, but we can't really predict the variability of those yields. So we'll just work with the information that we have at hand. With 13 trades, at an average, if I were to simply get 1.67% on each of these trades for a 27-day period, that means my annual return is about 21.71%. Almost 22. That's actually nice. I like that. I'm really shooting for an average of about 18. In the world of what's good enough, this is more than good enough for me. Some people are going to prefer to do better. And especially if you have an opportunity to even close the trade 4 days earlier, you're going to be doing a little bit better. And here's, again, the comparison. 365 days, if I can do that every 23 days, now I've got 15 trades instead of 13. I've got 2 more trades at 1.67%. It's going to be a little over 3.2% for the cumulative total. So 15 times 1.67%. Now my potential return goes from just a little under 22% to now 25%. 3% difference per year may not sound like a huge deal, at least on a 1-year basis, but if you're doing 3% more every single year over time, that's another way that you start to take advantage of the effect of compounding. And so this is where trading frequency really starts to make a difference. We can also get a lot more dramatic, and we can find examples where a trade may be a week to 2 weeks from expiration, but you're getting a good move in the direction that you want. And sometimes that gives you an opportunity to accelerate that compound effect even more. So there are some advantages to being able to buy this back sooner, and it's why in some of these sessions, I've had some of the people in our group who love to use the rolling strategy kind of start yelling at me, because they want to know why I haven't done this already, why I continue to do it the way that I have. Well, this is what works for me. It's what makes things a little bit easier to manage within the context of everything else that I have to do. Barry, thank you for this comment. He says, depends on the value of the stock as well. If you're closing early and wanting to trade the same stock, you will be selling a put at a higher price. That's a great comment. I love it. And exactly to your point, let's show exactly what people mean. If I wanted to go out and roll for another week, in order to be practical, considering the way that Comcast has moved. Now, I'm not saying that it has moved past the point where it's not a good bargain anymore. In fact, it still hasn't. It's still a pretty good bargain. And so this is a candidate for a trade next week. We'll see where the numbers line up at on Tuesday. But let's just say, for example, if I wanted to be an active roller, okay, the 39 is just not practical. I'm sorry, I'm not going to go and sell for 4 cents for 7 days. It doesn't make any sense. But I could sell the 41.50. The stock is at 41.87, so that's 37 cents out of the money. That's not bad, and you're getting a little over 1% for 7 days. So there could be some logic in buying this back now, so you get that $3,900 released. That capital is available, and then assuming you have the additional excuse me, $2,150 to reserve the trade for the 41.50 strike price, you're bringing in 47 cents per share. That's, again, it's not quite 1.5%. It's a little over 1, but not by a ton. But again, if we talk about trading frequency, remember, with my 3 week time period in place, we're talking about an average of between 22 and 25% per year, right? Well, what do I get for 47 cents? If I divide that by 41.50, it's a 1.13% for 7 days. Sorry, I'm gonna have to reverse it. 7 days. 7 days. Sorry, that was kind of weird. For 7 days worth of time. That means that instead of a new trade every 3 weeks, 3.5 weeks, now you're doing one every single week. Even I can do this math without a calculator. That means possibly up to 52 trades. So what does that mean? 1.13% times 52, you're at upwards of 59% per year. This is why a lot of the people who are the rollers in our group really kind of agitate for this. And when I show the comparative numbers, they really start to get after me about why I'm not rolling more actively, and that's okay. There is a lot of sense to being able to do this. The caveat is that you have to be able to manage these actively. You have to be by your computer, or have your phone available with with your trading app, and be willing to spend time paying attention to the market during the day, every single day, if you're going to try to manage these trades actively. That factors into your decision of whether you want to be more active roller or take a little bit more passive approach like I do. Okay, so that's Comcast. Anybody else who has another thought about this, or maybe wants to throw out some comparative numbers? I like giving out tick marks, so if somebody's done better than me, that's fun. While you're mulling on that, we'll go ahead and take a look here. The next stock here is Nike, and this was the trade that I placed on the 11th. Again, set for expiration today. So 2 positions today, setting up for for expiration. Selling the $76 strike, and this was a little over 1.5% was the premium that I brought in for about 2 weeks of time. That again, this is a very nice trade. This is more than good enough. I'm really only trying to average about 1.5% per month, but if I can do better, then I like to do that too. So let's take a look here at Nike. Let's check in and see where it sits right now. And it's at $90. And we can see that it's picked up a lot of momentum here just in the last, really just since last Friday, really. It's really started to gap up. Coming up on earnings here. So this is one of the things that I liked about this trade is it went right up to, but didn't cross earnings, since earnings are coming up next Tuesday. So this closes the trade and the possible obligation. Even if I don't buy this back before expiration, I don't need to worry about the earnings announcement. I can wait and see what the numbers look like on Tuesday and try to make a decision about what I want to do with Nike after that. If numbers are getting better, maybe the value proposition is still really attractive, even with, excuse me. Wow. I apologize. It felt like I needed to sneeze for a second. So even if the stock, even with the stock's increase in price, we'll see where the earnings land if they're getting better. Bottom line is continuing to improve, which was already very strong for this company. Maybe the value proposition is still really attractive. So this still could look really nice at about $90. It is interesting to see it coming up close to resistance at around $92. This is from the 200-day moving average. And that may keep the stock down a bit. That wouldn't be the worst thing, not for a put seller, right? Because that means that if the value proposition is still really attractive and it just kind of starts to maybe it starts a new consolidation period before it pushes above the long-term downward trend, that's okay for income generation. That's really, really useful. So we'll see what happens here. So with just like with Comcast being in it, selling the $76 strike price here, obviously I'm in a really nice spot here to let this expire worthless, and it's been that way pretty much since I placed the trade. It's been rallying up nicely from that price. So let's go ahead and let's just take a look at the options chain. I'm going to have to expand this out quite a bit. 24 strikes wasn't enough. There we go. Here's 32 strikes. Okay. So here's the $76. Whoops. Apologize. Let me get my drawing tool back really quickly. All right. There we go. Here is 76. So again, buying this back for a penny potentially. That's just because you can't buy it back for less than a penny, right? We don't have hay pennies or half pennies, but there is. Let's take a look here. There's no activity here, no volume. there is some open interest. So if I wanted to buy this back, I could, and that trade would get filled. That would mean that I get to hang on to them to the 99% of the $1.20 that I brought in. Again, this is one where, if I want to think about rolling it, I'm going to have to plan to roll ahead and up by quite a bit from where I was, from 76. So, here's 285 for 1 week. That might not be the worst thing. At 90. Let's go back here. Stock is just right around 90 now. Let's try to figure out where support is likely to be. We like to use the idea of previous resistance as support. This blue line should work out pretty nicely. We can see here in this period that this was acting as resistance. It broke out yesterday, and so now this line at around $89 should act as new support. It's literally 88.80, but remember that this is a price area, not a specific price. So we'll work with 89, and so that should be current support. So let's see. We had a 285 at 90 and 236 at 89. So if you really like Nike, buying the $76, buying the $76 strike means that the $7,600 that I put on in reserve for the trade would come back to me, and would have to add some to that, about $13 per share. But assuming that you've got the cash or margin available to do that, the $89 strike is interesting. Bringing in 236, again, this is for 7 days. 236 divided by, 89, 2.65%. This is an outsized yield for 7 days. Why? Anybody have a guess? I'm going to take a drink real quick while I'm waiting for a response. Seven-day trade offering more than 2.5% yield for a 7-day period. Why would it be offering so much when it's pretty normal to get around 1%, maybe even a little bit less than that for a 7-day period? Answer is right here. Got earnings coming up next Tuesday. So if you are going to try to roll this immediately into a new position, you've got to make a decision about holding that position through an earnings announcement. Now, that doesn't always scare me off. In fact, if you've been following my trades for a little while, you've probably seen me set up a put sale or a covered call that extends across an earnings period. You got to be pretty confident about the company and their fundamental strength in order to do that. So if Nike isn't something that you would be that confident about, then you probably don't want to do that. But it does offer an opportunity to kind of maximize the income that is available if you're not afraid of the volatility that can happen around earnings. Look at Comcast. Excuse me. Look at Comcast and the way that it accelerated out of its earnings report. Look at other stocks that have recently come out of earnings. Let me just go to one that I was looking at this morning. Here's General Mills Food Company stock. Earnings was right here, and big swing just that day. And right now it's kind of hovering now but you see a pretty big swing out of earnings. Borg Warner picking up a lot of momentum right now. Earnings were back here. You got to try to think about how you would respond to a stock coming out of earnings if you're going to have a trade that crosses it. Here's Micron that just had its earnings earlier this week on Wednesday, and you can see the stock gapped up and now it's coming back down again. That's really nice if you were in the trade before then, but what does that mean about the stock now? We don't know, but this gap could have just as easily, if the market didn't like what was in the earnings report, instead of going from, what is this, about 95 to 110, it could have easily come down to here and done one of these. Sorry, this is a really ugly candlestick. So it could very easily have come much lower and gapped the opposite way. So you've got to think about whether or not you're willing to tolerate that kind of price volatility. But that is a very outsized yield that is available right now. That's why it's not a recommendation to buy or sell any of the stocks that I'm talking about here. I'll keep my coward's door swinging very wide open here, but these are things to think about. Okay, so these are the only two trades that are really set for expiration for the next few weeks. On my Rebel Income trades, you can see that everything else is the 18th or the 25th. That includes put sales on Suncor, which was last week, and Bank of America, which was this week. And then I've been able to place a bunch of covered calls, which is pretty nice. Let's go ahead and we can revisit. We can take a look at these if we want. But before we do that, let's offer an opportunity to open this up for some review of other stocks that you may be following. So go ahead and in the chat, go ahead and let's if there is a stock you're interested in having me review for the group, and maybe open up a little bit of discussion about what that may be looking like right now. Let's go ahead and do that. All right, you want to drop something in there, then we'll certainly come back to it. Otherwise, let's go ahead and just keep looking at these others. Let's start with Suncor. Let's talk about energy for a second. I've been working a little bit more and paying a little bit more attention to this sector over the last couple of weeks as energy prices have been coming down. That is starting to impact some of the stocks in the sector that I like to follow. And Suncor has certainly been one of them. So let's take a look here at what that's doing right now. And it was rallying pretty nicely up until Wednesday. And it's dropped back pretty sharply from probably about 38.50 here at this pivot high point. And it appears to be finding support maybe 36.50. And it's right around 36.76 right now. So picking up some bearish momentum, looks like it may be stabilizing around the 200-day moving average. What does that mean for the trade that I placed? Well, here's the $36 strike price that I sold. All right. Stock is a little bit above that point. So I was able to make this pretty conservative. The stock was down around in this price area when I highlighted the trade. And so I was able to get the $36 strike price. That gives me some room to work with, but bearish momentum may be increasing on this. And so maybe that makes this look a little bit scary. Again, if you're an active trader, one of the things that you kind of have to pay attention to is the potential for these movements against the position. Remember, $36 represents an obligation that you are required to meet when you're an option seller. If I'm selling a put, as I did here, that means that if the stock drops below $36, remember these are American style options, so anytime before expiration leading up to the expiration date, if the stock is below that price, below the strike price I sold, I could be forced to buy the stock at that price. So that may create an obligation that maybe is not quite something you want to do. You have to think about this very carefully if you want to be an option seller. Think about the obligation side of those contracts and then decide if that's something that you're willing to try to meet. In my case, I don't mind this because 36 is a great price for Suncor, but I also have to recognize, the state of increasing bearish momentum that is happening right now, even if it is finding support around the 200-day moving average right now, which is a favorable thing. I also have to acknowledge the possibility that it could break below, sorry, that's really ugly, but it could break below $36 and create that potential obligation, possibly before the option expires. So if that's something that would create difficulty in my portfolio, or if it's not part of the strategy that you want to follow, oh my, Barry says he's in the middle of a hurricane, also working out concession details for a home purchase. Good luck on the home purchase, and even more to the point, yeah, that's right, you're in Florida, and so the I'm sorry, I can't remember the name of the storm, but certainly our thoughts are with you and your wife and everybody in your area. Hope that you stay safe and that all goes as well as it can. So thank you for being here. I do appreciate it, even under the circumstances. So Suncor, Georgia, didn't get hard, but have basement flooding. I stand corrected, not in Florida. Didn't get hard, but you have basement flooding. So certainly a far more minor than it could have been. So, but still, yeah, that does create some extra work for you, doesn't it? Nothing quite like trying to drain a basement. Had that happen, even being out here in the desert in Utah. So rental house, not our circus, not our monkey. There you go. There are some things to be grateful for, right? If you don't own it. All right. So Suncor, again, my obligation is potentially 36. Now the expiration on this, as I mentioned, sorry, wrong list, right here, 36. Expiration is October 18th. So I've got to go down a little bit here. It's 21 days away. Sold I brought in 63 cents on this. Yes. Remember, this was just placed last week. The stock has seen some movement since then. And that means that right now, if I were afraid of the bearish movement on Suncor right now, wanted to buy this back, close out the obligation limit, any potential downside I might be exposed to, I can do that. I'd have to buy back for 59 cents and keep 4 cents on this. Pretty much come up sixes when all is said and done. Again, if you're an active options seller, why might you want to do this? Well, again, the potential of the put sale assignment is something that you have to think about. If that's a risk you don't want to incur, then sometimes being very quick to get out of positions that may be moving against you, so that's going to be something that can be a critical element of success. Loss management, minimizing the potential obligation that you may be taking. Now, in my case, I'm the type of person that lets the option extend all the way to expiration. If I get assigned before or on the expiration day, I'm okay with that. That's because I am tacitly going in with the understanding that I would like to own at Suncor at $36. I use the put sale as a gateway to that ownership. And I want to be able to have, I would like to have the opportunity to own the stock, take in some dividends, maybe write some covered calls on it. Not everybody fits into that category. And so if the potential of taking an assignment isn't attractive to you, this is what it would take right now to close that obligation. The advantage is that as soon as you buy it back, that obligation is removed. The capital that you used to reserve the trade goes back to you. You can go ahead and move on to another stock and pick something else. As it stands, if stock is still above 36, that puts me in an okay spot, and it gives me a little bit of time to work with. How much time, I don't know. Again, if you're an active put seller, this could change very quickly, right? Depending on what the market is doing. Don't be don't ignore the fact that this momentum on the downside could pick up at any time. If you want to be more actively involved in managing your trades, then be aware. Set a trigger, for example, whether it's on your charting tool, in your brokerage account, whatever it may be. Set a trigger to notify you if the stock drops below a price that you're not willing to continue to work with the stock at. And then do whatever you have to do to close the trade. If you end up eating a little bit of a loss, better that than having to do what happens sometimes to me, which is taking an assignment and watching it extend through a protracted downward trend. I don't mind those. Again, these are stocks I'm willing to own. I like the opportunity of being able to take in dividends. I believe very strongly, no matter what the market is doing, that the value proposition is much higher. This is kind of a contrarian view. It's why I don't mind looking at stocks that are in downward trends, and you see me placing trades on stocks in downward trends. Because these are kind of contrarian plays where I believe the stock should be worth more than the market is telling me right now. All right, so this is Suncor. Again, you can do what you feel like you need to do with it. Let's go ahead and move on to the other put sale that I placed this week on Bank of America, selling the $38 strike price. Again, brought in 63 cents on this one, just as I did with Suncor, about 1.66% 3-week trade. Again, this also expires on the 18th. Stock's about the same price it opened at today, $39.50. Again, I sold the $38 strike, and this is a stock that has rallied just a little bit since Wednesday when I placed the trade. It had dropped back to this point, found a nice little pivot low. So we've got good support here, a little bit below 39, it looks like. I'll just go ahead and call it 39. We'll see if it can get back up. It's got resistance. This looks like about 41. If it can break that, then it should be able to test its 52-week high. So we'll see what that does. May tighten the range between the 20 and 200-day moving averages as well. So we'll see. There's a little bit of room here with this distance between the stock's current price and even this low point at 39 and the 200-day moving average, which is at about 37. There's a little bit of downside here in the very near term of about $2 that could happen pretty quickly. Again, kind of like we were just talking about with Suncor, that may raise some concerns. Right now, the stock is $1.50 above the strike price that I sold, so it's moving pretty nicely. But that does increase the distance. We've got about $2.50 between the stock's current price and the 200-day moving average. So if bearish momentum increases at all, which we saw a real steep drop here in August, if this current consolidation fails to hold support, low end of 38, it could easily fall below, and we'll see what happens. But for now, I like the fact that it's rallying at the moment. We also have really solid support coming from the 200-day moving average, and the stock has been following that slope pretty much since this low point in August. It's just doing it a little bit above, a little bit higher than we would normally expect instead of tracing right along the 200-day moving average. So kind of interesting how that's working. So we'll see if that continues to hold that pattern. It does have earnings coming up here on the 15th of October. So this is an example. Remember, I said I'm not afraid of working with a put sell that may cross earnings. Stock may pick up some volatility before that earnings announcement. We'll see what happens. But this may also be a reason to pay attention to what's happening in the week, 2 weeks before expiration, and that may change some of your decisions about how to manage the trade. That's okay. That's a good thing, as long as you're trying to keep these things in mind. Let's go ahead and really quickly just take a look at some of the covered calls that we've been able to stack up here in the last week or so. We've got gold. This is Barrick Gold, a stock that I've held for quite some time. Excuse me. So last week I was able to sell a covered call on this at the $21 strike price, bringing in about 2.3%. That's a little above the price that I was assigned, which is kind of nice. This rally kind of came in the face of uncertainty as to whether the Fed would follow through on its rate cuts. And yesterday was peaking at around 21, and today's coming off a little bit below my assignment price at 20.50. That's okay. I've held this stock for quite a while. I think it's a good hedge against some of the risks of inflation and some of those other elements. And so, as long as concern about inflation continues to persist, I don't believe that this is a bad position to hold on to. Pays a nice dividend, 10 cents per share per quarter. So it's about 2%. Not huge, but certainly more than enough to be useful. And I've been able to enjoy those dividends for the duration that I've held the stock. Even this is a good example, though. One of the things that you have to keep in mind when you're selling put options, if you take an assignment, you may see the stock extend into a very protracted downward trend. In this case, I sold my put option back here in, let's go back. Let me check my records just a second. June of 2022. So stock was, in this price area when I sold that put option. And I watched the stock drop all the way down here to close to 13 and stay lower. It's come back up a couple of different times, but stayed quite a bit lower for the majority of the period that I've held the stock. And it's really only been in the last few months that it's really been able to pick up a lot of really useful momentum. Will that hold? Don't know. It could rally higher. That would be nice. If not, we'll see. But got about 3 weeks to expiration on that covered call, so we'll see where that lands, and that's fine. If I continue to hold it a little bit longer, that's fine with me. Also have a covered call on AT&T. This is one that I was actually assigned at a higher price 2 or 3 years ago on AT&T after they split out their Warner Brothers Discovery unit into a separate entity. And with some of the other income generating trades, put sales, covered calls that I've been able to place throughout the time period that I've had it. My actual average cost in this is $21.60. So this $22 put option, or excuse me, call option that I sold for 40 cents was pretty attractive and offers an opportunity to maybe get out of the trade a little bit later expiration on this one, the 25th of October. So where is AT&T today? Came down a little bit to finish the week, had a pivot high around 21.25, but pushing up now close to 22. So it's starting to approach that level now. And I could get called out of this position any time that the stock is above 22. So we'll see if that momentum can continue. It is interesting to see the way that the 20-day moving average, the slope was already pretty aggressive since May, but it's even accelerated just in the last month. A lot of momentum coming into stocks like AT&T and Verizon right now. We'll see if that is maintainable or if the distance that we have between the 20-day at 21.37, we'll just call this 21, and here's the 200-day moving average at 18. So we'll see if this distance starts to become, something like a trap zone. Maybe it retraces a little bit. If it does, it may come back down, and I would not be surprised to see that happening, given how aggressively the stock has been rallying. But we'll see. Let's see, Borg Warner. I'm kind of excited to talk about this one a little bit because this is a good example. Tried to place a covered call a couple of times last week on this, and it didn't quite work out. And then I finally did get the trade that I wanted this week on Wednesday. So just to be clear, sold the $35 strike price. This is the same price that I was assigned the stock at. But brought in about 2.5% for a 3-week trade. That's more than enough, more than good enough. But here's the irony of what happens sometimes. I was assigned at 35. I'm selling my covered call at 35. So there is no capital gain if I get called out. And here is Tuesday when I wrote about the trade. It was just a little bit above 35. And here is Wednesday. The next day it was a little bit down below. So I thought it might be coming back down to retrace and find support around the 20-day moving average. And now what's happened in the last 2 days? Yeah, it's picked up a lot of bullish momentum, and now it's sitting at around 37. So bad trade for me. Did I make a mistake? Yeah. I don't think so. Keep in mind when you sell a covered call that you're putting an absolute cap on how far the stock can go for you. And thank you, Barry. Just like you're saying, not if you're making money. Got 2.5% for about 3 weeks on my covered call. Yes, I would be selling at exactly the same price that I bought the stock at, but I've been able to use Borg Warner for a number of useful trades up to this point, including its dividends. And I'm okay with this, even if the stock continues to follow this momentum and it finishes, multiple dollars, several dollars above $35 strike price that I've sold. C'est la vie. There's no way to know when the stock is really going to accelerate its bullish momentum like this. And sometimes this is going to happen when you're an option seller and when you're selling covered calls against stocks that you own. This is the way that it happens sometimes. You just have to be willing to accept that. Other times you'll end up maybe the stock reverses and the call ends up expiring. Sometimes it works for you, sometimes not. That's exactly right, Barry. It's just like any other trading mindset that you have, no matter whether you're talking about swing trading momentum. Some trades work out perfectly and beautifully the way that you want them. Sometimes they don't. The nice thing about income generation here is that even if I do get exercised, okay, well, I missed some dollars, but I'm still making money. And that's where Barry said, not if you're making, it's not a bad thing if you're making money. Still making the money on this if I get, assuming I get called out. Maybe not as much as I could have if I just held on to the stock and sold it. But again, there's no way to see that in advance. In the meantime, what was available was the covered call premium. So, all right, everybody, I hope this is useful. Thank you again, as always, for your time. I really do appreciate it. And just really quickly, thank you. I'm not going to let this one go. Go ahead and just hit on MGA, which is the other stock. I took an assignment on this one recently and sold a covered call on this one at $42.50. Again, the same price that I sold or that I bought the stock at. So I put the same cap on this that I have on Borg Warner, and now doesn't have the same kind of momentum, but it is picking up some momentum here, pushing. It was pushing close to 44. It's now around $43. Barry says he sacrificed the immediate premium, took a little less premium, went to 45, and gave himself a little bit more potential gain. Here's an interesting example, and I'll wrap up on this. MGA and Borg Warner are both interesting examples of a variation that happens with some of the option trades that we sell. And that's that these are stocks that do not offer weekly options. So you basically have monthly options. And in the case of MGA, you don't have $1 increments between strike prices. It's $2.50. So when I was looking to sell my covered call, I was looking at the difference between selling $42.50, bringing in an attractive premium for that amount, or maybe going out a little bit further, hoping to get some capital gain, but accepting a much lower premium. I went for the premium, the kind of the low-hanging fruit, right? Because I didn't know if it was going to pick up that momentum. Barry did the opposite. He went for the capital gain. It looks like you might be getting it in this case. So Barry, I'm going to go ahead and give you that tick mark, because that may be that. We'll see how this carries through. But if Borg Warner and MGA are any indication, there's some momentum that's building up in that industry, and that could keep those rallying for a bit. So you may be putting yourself in a much better position than I did. Appreciate that. Thank you. All right. Again, thank you for your time. As always, I do appreciate it very much. I hope everybody has a wonderful weekend. If you have any questions, don't hesitate to let me know. You can message me directly on Discord. If you prefer to send me an email, you can do that to rebelincomesystem@gmail.com is my email address. I'll drop that in the chat really quickly. I'll respond to those emails just as soon as I can. If you want to message me in Discord, I'll probably be able to respond to those a little bit sooner. In any event, thank you again, As always, hope you have a wonderful weekend. Barry, try to stay dry, and we'll talk again next time.